Hello, everybody. Thank you so much for joining us today for our monthly webinar. Today, we're focused on maximizing your Social Security strategy. And I'm Betsy Kenyon. I'm the marketing coordinator here at Elevate Wealth Advisory. If you're new to us, we are a wealth advising firm in Athens, Georgia. We were founded 40 years ago, almost 41 in a couple weeks, by Chuck Vickery, who is going to be our presenter today. Chuck founded the firm in 1982 with the goal of helping people make smart decisions with their money. And we're still doing that today, except instead of one person doing it, we've got a team of 11 people helping you and giving you wealth advice to help you live your best life. Now, Chuck, I'm excited to introduce you, but before I do, I just wanted to tell everybody a few things. Down at the bottom of the screen, you'll see a chat box and a Q&A box. So if you have any questions for Chuck today throughout the presentation, just put those down in either of those two places and we'll get to your question at the very end. If for some reason we don't make it to your question, we will go ahead and email you the answer. And if later on today you think of something you wanted to ask, just feel free to email me at marketing@elevate-wealth.com. Now I'm excited to introduce Chuck. As I said, he's our founder. He is a very, very proud University of Georgia graduate, and he's been active in the Athens financial community since he was discharged from the Army in 1972. He and his wife, Patsy, are both active in the community here in town. And now, Chuck, I'll just let you take it away.
Well, great. Hello, everybody. I started with this brain teaser just to get you thinking just a little bit. In life, would you rather be early or delayed? Or would you rather pay a penalty and get a bonus? And just think about that. I'm not going to ask you right now, but we're going to come back. And as Betsy said, I'm Chuck Vickery. I'm a wealth advisor here at Elevate Wealth. And they're letting me do this because I'm the only person in the firm that's actually drawing Social Security. And I am a baby boomer. And so we're going to talk about what baby boomers need to know about their retirement income. So what we are finding is that a lot of people are hurting their retirements by making terrible, costly decisions about Social Security. Well, as a financial planner, why is that important to me? Well, it's important to me because we're trying to help people, as Betsy said, to live your best life and give you the tools to live the life that you envision. And it just makes it harder if you make mistakes in how you collect your Social Security. So there's some things you need to know, and one of those is that you have many claiming options. I think there's actually, if we really nitpick, 18,000 different ones. There's really just 5 or 6 big ones. And we're going to talk about those because these decisions have very far-reaching consequences, and the choice that you make impacts not only you, but your spouse. I was talking to Social Security, somebody earlier this morning, and said, oh, that's why the system's going bankrupt. Well, it's not going bankrupt, and it's not a Ponzi scheme. It's live, it's real, and you probably know somebody that's benefited from receiving Social Security. And a lot of times people get advice from their friends. There's just one problem with that. Your friends are not experts when it comes to Social Security. So what boomers want to know is, will it be there for me? How much can I expect to receive? When should I apply for Social Security? And how can I maximize my benefits? And will Social Security be enough for me to live on? I think you know the answer to that, but we're going to just take a look at some of these. And a lot of times people underestimate the value of Social Security. And for many people, it makes up it's the foundation of their retirement. And folks want to know, will it be there? You know, there are 2 big government agencies that just about everybody deals with. One's Social Security, the other's Medicare. And most people know very little about it when they first start. So people, as you get closer and it's time for you to begin drawing benefits, will it be there? Well, we do see that the trust fund balance has a $2.8 trillion balance, and it is paying out a little bit more than it's taking in right now. And Social Security has always been a pay-as-you-go system, so that those folks that are working pay in and that money comes out. And if there's a surplus, it's held back by the Social Security system. But we're starting to encroach on that surplus right now. And what that tells us is that if nothing changes, long-term projections say that in 2034, benefits are going to be reduced by 20%, and people are going to get about 80% of what they have been getting or what they have been promised. Now, there are a lot of proposals in Congress to rectify this situation. The four main ones are: one, just tax more money. And currently, the first $160,000 you make, you pay 6.2% on, and your employer pays that. Raise that 160, that'll probably happen. Raise the normal retirement age. When we were kids, the normal retirement age was 65. In 1983, they changed it to 66 and 67. No major rights because it was so far in the future. So maybe they'll make the normal retirement age 70 for those people that are 35 or maybe even 40 today. Lower benefits for future retirees. I'm going to show you how they calculate the benefits. And you could make just small percentage changes there, and it would it'd be painless, and it would solve a lot of problems. And then they can take a look at the cost of living adjustments and maybe use something different. But the bottom line, if you're a baby boomer and you're about ready to get Social Security, or if you're already receiving Social Security, is that your benefits are not likely to be affected at all by any of these reforms that are being proposed. So, what's a clear way to think about Social Security? Excuse me. Well, insight number one: Social Security is inflation-protected income. You've paid the premium in every paycheck, so be smart about how and when you collect it. So when we say it's inflation-protected income, what we mean is it's income that you cannot outlive. And it's probably going to be more than you think it is. If your monthly benefit is $2,000 today and you live 10 years, with a 2% cost of living adjustment, which is a modest adjustment, your benefit's over $250,000. If you live 20 years, it's almost 600,000. And if you live 30 years, it's right at $1 million. So not only can you not outlive it, but you're going to get pay raises with it, with these cost of living adjustments. So if the benefit starts at $2,000, in 10 years, it's $2,400. And in 20 years, it's $2,900. And in 30 years, it's $3,600. And obviously, if your benefit's higher than that, the adjusted benefit will be a good bit higher than that. How do you know how much you personally can receive? And how much can you expect to receive? Well, the best way to figure that out is to take a look at how things are calculated. And so the Social Security system goes back and they look at how much you earned over your working career. And they take a look at the age in which you apply for benefits. And a lot of people know that the earlier you apply, the less you get. So, but how they calculate the benefits is at age 62, they go back and they take your earnings from day one, they index it for inflation. They take the highest 35 years of earnings and they use their average. That's called AIME, that's average income monthly earnings. And then this is divided by 3 bend points. And then they calculate your benefit. And then that benefit's increased each year for COLA. Well, how do they calculate it? It's a formula that you can do. It's time consuming, sometimes frustrating. But if you were born in 1961 and you turned 62 this year, 2023, the maximum Social Security earnings, and you paid in the maximum every year since age 22, your AIME, your average index monthly earnings, is $12,427. And that figure came from taking the first $1,115 a month, and you get 90% of that as a benefit. The next $5,606 a month, you get 32% of that, and the last $5,706 a month of average index monthly earnings, you get 15% of that. When you add those up, the primary insurance amount, which is your monthly benefit, is $3,653. And that's the maximum that you can receive if you're retiring today. Okay. So, and I know that's good to know, but why shouldn't I claim early at 62? Why do I want to forfeit all those checks and wait until full retirement age or even later till age 70? Do I really want to do that? Well, your monthly benefit will be reduced if you claim early. It probably will be reduced for taxes. And when you're on Medicare, those Medicare premiums are taken directly out of your Social Security checks. Okay. And if you can claim early and you continue to work, you may have some money withheld from you. So the question then becomes, when should I apply for benefits? Well, it's an important question, and a lot of factors go into applying for it. Number one is your health status, your life expectancy, your current need for income, whether or not you continue planning to work while receiving benefits, and do you have a spouse that has survivor needs? So it's important to play all these and put them together. So it's difficult to answer without knowing a little bit more about you, but these are considerations and factors that you need to pay attention to. Will it be enough to live on in retirement? Probably not, but it does make up about 40% of the average retiree's income. So what you need to know about Social Security is your claiming age has a lot to do with your benefits. So we have what we call full retirement age. And full retirement age is the age which you can claim full unreduced benefits. It used to be 65, but now it's 66 and some odd months, or 67. But you can see the different ages here as to when full retirement is. But that's when you get full unrestricted benefits. And if you apply early, and you can apply at age 62, you can see from this chart that if your full retirement age is 67 and you apply at 62, there's a 30% penalty. And at 63, a 25% penalty, and at 64, a 20% penalty. So you have to get down to either age 66 full retirement, or 66 in months, or age 67 to get into your full retirement. So if you apply early, there is a penalty. Well, what if you apply late? If you apply late, you get delayed credits, and those delayed credits are 8% a year. So again, you can see at age 67, if your full retirement age is 67, you get 100%. But at 68, you get 108. At 69, 116. And at age 70, 124%. So it's nice to know that there's a bonus in there if you delay benefits, and you just need to do some planning to see when you should start and how you should start. And we're going to talk about coordinating your benefit with other assets. But one way to estimate your personal benefit is to obtain your annual Social Security statement. And they used to mail these out, and they don't do that now. But you can go to www.socialsecurity.gov/my-account. And if you don't already have an account set up, you should do that. They're going to ask you some questions to make sure that you are who you say you are. And then you can see your statement. And on that statement, it will tell you what your projected benefit is if you claim early, if you claim at full retirement, or if you claim at age 70. You can also use the retirement estimator. And if you do that, they're going to ask you for your date of birth. They're going to ask you for your Social Security number. They're going to ask you for your mother's maiden name. These are secure sites, so that's okay. You can give them that information. So, but people say, well, why should I delay benefits? Well, obviously, it's at 8% a year. So if your full retirement age is 67, you get 100% of your full retirement amount. And let's just assume that's $3,000. Well, because of cost of living adjustments of 2%, when you actually get to age 67, it's not 3,000, it's 3,312. But look up above it. If you start at 62, you've got that 30% discount, that 30% penalty. So you get $2,100. And if you start at 63, you get 22. And if you start at 64, 24, and so forth. You can see how it goes. So, and if you delay the benefit down to 70, then that 3,000 becomes 3,720. And when we put the COLE benefit on it, it's $4,359. You delay benefits to get a bigger check to start and to get a bigger check later on, because COLA really impacts this as we go forward. And here's an example of that. 3%, a $3,000 benefit, 2% cost of living adjustment. Claim at 62, you get $2,460 when you're 70. And when you're 75, 27, and at 80, $3,000. Well, if you wait until 67, at 70, you're not getting $2,400, you're getting $3,500, $1,100 more a month. And then at 75, $3,800, again, $1,100 a month. And at age 80, you're getting almost $1,300 more a month. And the difference is those codes. And if you claim at 70 and you've got those delayed credits, you've got $4,300 at 70, $4,800 at 75, $5,300 at age 80. You know, a couple age 65 today, there's about a 25 or 30% chance one of you will be alive at 95. Look at those benefits at that time. So if you expect to have an average to a long life, you're much, much better off, sometimes by hundreds of thousands of dollars, by delaying as late as you possibly can. Do not delay beyond age 70, because there's no additional increase, and you're just not getting your check. So it doesn't do any good to delay beyond age 70. So how can I maximize what Social Security is actually paying me? Well, one way is to get your statement and take a look at it and see, number one, is it accurate? Are any years missing? Sometimes maybe you work for, you changed jobs in the middle of the year and something didn't get reported. If that's the case, let's find out now. Possibly there were some years where you had very low income and your income's dramatically higher now. So by working a few more years, you build up your average. Or maybe there are some years where you didn't work at all, especially for women who stay home with children. They've got some zeros in there. Can we get those zeros out and get the average up even higher? So what we want you to do, once you know that, is to apply at the optimal time and consider your income needs both now and in the future, your life expectancy, and your spouse's life expectancy, because sooner or later, something may happen to you and your spouse may need these dollars. So now, if you are receiving Social Security, unfortunately, it is taxed by the federal government. The state of Georgia does not tax it, but the federal government does. So if you apply for Social Security before full retirement age and you continue to work, for every $2 you earn over $21,000 a year, they take back $1 in benefits. Now, it's not a permanent reduction, because when you get to be full retirement age, they go back and recalculate your benefit. But where this is important is maybe you retire and you start Social Security. And let me just make a comment here. Retiring and taking Social Security are two independent decisions. It's not one. You can take Social Security and work. You can work and not take Social Security. You can quit and not take Social Security. But if you happen to retire and for various reasons, people go back to work, Maybe something comes along that they're very interested in. Maybe they're bored. Maybe it's something fun. Maybe it's an opportunity that they can't pass up. Don't let this earnings test discourage you from working, because they will come back and readjust the formula at full retirement and increase your benefit at that time. And so that's not really a tax, that's just an adjustment. But there could be a tax on your Social Security. So we'll look at the top one here, married filing jointly. If your provisional income is under $32,000, you do not pay tax on Social Security. What is provisional income? Provisional income is all of your income subject to taxes except your Social Security. So you take all your other income, you take 1/2 of your Social Security, and if you have any municipal bonds where the interest is not normally subject to tax, you add that to it too. So it's earnings other than Social Security or taxable income other than Social Security, half your Social Security, municipal bond interest. That's provisional income. So as I said, if it's under 32,000, you don't pay any tax on it. If it's between 32,000 and $44,000, then up to half of it may be taxed. And if your income is over 44,000, then you're going to pay tax on 85% of your Social Security. And many people pay that tax on that 85%, and it's frustrating. I like to look at the positive side and say, hey, I've got some income coming in, and 15% of it is totally tax-free. So if you're single, same scenario, just a little bit different numbers. And there are some ways to minimize these taxes. One is to reduce other income with tax-advantaged investments, but not municipal bonds. We also do another program called Spend Down, or Strategies Through Retirement, and we talk about the different phases. And one phase that we talk about is the transition phase. And transition phase begins when you get your last paycheck, and it ends when you start your Social Security and taking money out of your retirement plan. So there's a small window of opportunity in there, and decisions that you make in your 30s and your 40s about how you position your money comes into play here in using tax-advantaged investments. Position your money properly. We say the transition phase is where the magic happens, because you can make some adjustments here, because you don't have to start Social Security and you don't have to start taking money out of your retirement plan if you have some other assets to live on, and basically get into almost a zero tax bracket, and then go in and make changes and take advantage of these very low tax rates to get your personal situation back on track and back in order. And the second one here is anticipate IRA required minimum distributions, which can put you in a higher tax bracket. Consider drawing money out before 73. This is the time maybe to take excess money out. Do not waste those low tax brackets. Convert traditional IRA to a Roth. Again, you may be in a very low tax bracket when you first retire. This is a great time to do a Roth conversion and get money from a fully taxable position to a never tax position. And by delaying Social Security, it reduces the number of years that you're going to be paying tax on it. And if you can sort of simplify your life and reduce your expenses and pay down your debt, hey, you don't need as much income, you don't have to pay as much in taxes, but you do need to continue to manage taxes, not only through the transition period, but through the remainder of your life. It's something that you need to pay attention to. So when we look at when to apply for Social Security, we know that if you apply early, your benefit starts lower and it stays lower for life. We know that cost of living adjustments, COLAs, magnify the impact of early or delayed claiming. The longer you live, the more beneficial it is to delay benefits. Your benefit may be taxed and reduced to cover your Medicare premiums. It will be, I can promise you that. And don't let the earnings test discourage you from working. And delayed benefits may give your surviving spouse more income. So I'm not going to live so long. So why shouldn't I just claim the benefit while I can? Well, there's a reason for that. And it's for couples. You should always maximize the higher earner's benefit to protect the surviving spouse. So let me give you an example. 1935, when Social Security was enacted, women were not paid. They were called homemakers. And to protect homemakers, a provision was put into the Social Security law and the rules that the non-working spouse could get 50% of the working spouse's benefit. And then, or the lower earning spouse could get 50% of the higher earning spouse's benefit. So here's an example. John's PIA, that's the amount he gets each month, is $2,000. Jane's is $800. If Jane applies at full retirement age, her benefit will not be $800, it'll be $1,000. It bumps up to 50% of John's. So that's the spousal benefit. So if it's done right, you're going to get at least half of your husband's or your higher earning spouse's insurance amount or monthly payment if it's done at full retirement. So there are some rules for you to be able to claim spousal benefits. And the first rule is that the primary worker must have filed for benefits. So in the previous example, Jane gets her $800, but she doesn't get her $1,000 until Joe claims his benefit. The spouse must be at least 62. And if you do that, when you apply at 62, you get that reduced benefit. And at full retirement age, you get the full benefit. There's no delayed credits on spousal benefits. So you want to go ahead and claim those at full retirement and not later than that. And we want to coordinate these spousal benefits, again, to maximize what we're doing. So the maximum strategy, the maximization strategy, is where the lower earning spouse's primary insurance amount monthly benefit is more than 50% of the higher earning spouses. Then the maximum strategy or the best strategy is for both spouses to delay until age 70. So let's maximize his lifetime benefits on average or long-term life expectancies. If you both have short-term life expectancies, you may want to do something different. But if you think you're going to lead an average life, this is the strategy that will get you the most money. There is a hybrid strategy where the spouse did not work or where the lower earning spouse's primary insurance amount is less than 50% of the higher earning spouse. And in this example, the lower earning spouse claims early. Go for it at 62 if you want to, as long as you're not working. The higher earning spouse, however, does wait and claim at age 70. And this generates income sooner while maximizing higher earning spouse's benefit over both lifetimes, not just the higher earning spouse. So the question comes up, well, I'm already widowed or divorced. So how does that impact my Social Security claiming strategy? Well, it makes a difference. If you're widowed or divorced, you may be eligible for survivor benefits, divorce survivor benefits, or divorce spouse benefits that can increase your monthly check. So let's talk a little bit about survivor benefits and the two key factors here. The survivor benefit will depend on the age at which the deceased spouse originally claimed his benefit. That's called the original benefit. And if the deceased claimed before full retirement age, then survivor benefits will be limited to the higher of the deceased spouse benefit or 82.5% of his PIA. So if he started at 62 and there was a 25 to 30% penalty, we don't use that 70 or 75%. We bump that up to 82.5% for the surviving spouse. If the deceased claimed after full retirement, then the surviving spouse will receive a benefit that includes the delayed credits. So that's how we calculate the original benefit. And then what the survivor actually receives depends on the age at which the widow claims the survivor benefit. So if the widow survivor claims before full retirement age, the survivor benefit will be a fraction of the original benefit. For example, if the widow claims at age 60, she gets 71.5% of the original benefit. But if the survivor claims at full retirement age or later, the survivor benefit will equal 100% of the original benefit. So let me give you an example here. All right, if spouse dies while both are receiving benefits, the widow may switch to the higher benefit. So again, we've got Joe and Julie, they're married, both are over full retirement age. Joe's benefit is $2,800. Julie's benefit is $1,500. Joe dies. Julie notifies Social Security, and her $1,500 benefit is replaced by a $2,800 survivor benefit. Okay. Now, if Joe delayed his claim, what we find out, Joe and Julie are married. Joe's PIA is $2,800, but he delayed until age 70 claiming his benefit. So he gets 124% of that $2,800, or $3,472, not the $2,800. Julie's survivor benefit is that $3,472. So there are tremendous benefits for your surviving spouse. And so we encourage people to take that into consideration when you're looking at when you're going to file. There are rules for surviving benefits. For example, couples must have been married at least 9 months at the date of death, unless there was an accident. The survivor must be at least 60 for a reduced benefit. If they're disabled, they can claim 50. Or to get full benefits, they have to be full retirement age. Survivor benefit is not available if the widow remarries before age 60. Okay, unless that marriage ends. So if you're a survivor and you can claim the benefit, and if you remarry, then that benefit goes away because you'll be claiming on your new spouse. But if you wait until after age 60 or later to claim this benefit, then remarriage doesn't make any difference. Now, if you're divorced, an ex, so there's a divorced spouse survivor benefit available. So if the marriage lasted at least 10 years, you too can claim on the deceased and receive their benefit. So divorce benefits are the same as non-divorce spousal benefits. If the marriage lasted 10 years or more, the person receiving the benefit is currently unmarried. The ex-spouse is at least age 62. And if the divorce was more than 2 years ago, the spouse does not have to file for their own benefit. So there are advantages in doing this. The rules for divorce spouse benefits are more than one ex-spouse can receive benefits on the same worker's record. And we sometimes when we're doing this, we use Donald Trump as an example because he's been married 3 times and he's 78 years old. So he's been drawing Social Security for at least 12 years or at least 8 years. But not only can he get it, his first wife can get it. His second wife, I believe, is deceased, and his current wife can receive benefits. And benefits paid to one ex-spouse do not affect those paid to the worker, to the current spouse, or any other ex-spouses. So the divorced spouse benefit stops upon remarriage of the spouse collecting benefits, not on the remarriage of the worker. But if you're getting divorced spouse benefits and you remarry, then the thinking is that you will get benefits from your new husband. So, and that's not for survivor benefits. That's for the 50% rule benefit. So, gee, this is really a little more complicated than I realized. Well, you remember earlier the brain teaser? So there's you may have heard the phrase behavioral finance. It's a study and influence of psychology on the behavior of investors. And so our brain teaser, people would rather say, I'd rather be early than delayed, but I'd rather get a bonus than pay a penalty. Man, I think that the government and the Social Security Administration made a mistake years ago by using the words early or delayed. Because if you go early, you get a penalty, which people don't want. And if you go delayed, you get a bonus, which people do want. So I wish they would say, do you want a penalty benefit or do you want a bonus benefit? And you see a lot more people filing for Social Security later than age 62. Okay. So as I said earlier, people are hurting their retirements by making terrible, costly decisions about Social Security. And that's the purpose of this. We want to try to eliminate that because, as you know, Social Security now offers inflation-protected income you cannot live, including a benefit for your survivors. Your monthly benefit will be reduced if you claim early. Couples should always maximize the higher earner's benefit for the benefit of the surviving spouse. And if you're widowed or divorced, you may still be eligible for benefits that can increase your check. So how do you do all this stuff? Well, we think everybody needs a personalized Social Security claiming analysis to understand how and when to apply for their monthly benefit that will fit into their overall income plan. So in addition to this, you need to take a look at any pensions you have, your IRAs, your 401ks, your 403bs. Take a look at your required minimum distributions that start at age 73. Look at your non-retirement investment portfolio, your savings accounts. Look at your work income. And sometimes when we do these, we actually find that occasionally the circumstances vary, but sometimes we'll tell you to start before full retirement. You're better off. Not often, but it happens. So the problem in going to Social Security and talking to them about when do I start and how do I start is they do a fabulous job of estimating your benefits and telling you how much you are entitled to now. And they get paid for signing people up, apparently, because when I went and talked to them, I delayed till age 70. They about flipped out. They were trying real hard to get me to start early. What they can't do, because they're prohibited from doing it, number one, and number two, they don't have access to all the information, is project future benefits through scenario planning and help with innovating strategies designed to help maximize your personal benefit. So we know you have questions. When should I apply? What if I want to keep working? What if I've already applied? Is there anything I can do? How much will my benefit be? How can I coordinate spousal benefits? What's the best long-term strategy for my situation? And what do I need to do next? And we think Social Security is too important for guesswork. So let us help you protect your nest egg and maximize your income in retirement. And I'm gonna go out on a limb here, and we'll do this complimentary. If you would like to come in and find out how to maximize your Social Security for you and your spouse, we'll take time to visit with you and do that. So that's my presentation. Any questions, Betsy?
Thank you so much, Chuck. That was informative as always. I love how I learn something new every single year. If you want to stop sharing your screen, we do have a couple of questions that have popped up. And then again, if anyone else has a question, you can put that in the chat box. The first one is going back to the provisional income slide that you showed.
Mhm.
What are some examples of tax exempt income? You'd mentioned one or two
Well,
things.
that's municipal bonds primarily.
Okay. Is there anything else
They
that would
don't,
be?
you don't have to pay federal tax on municipal bonds, but for calculating whether or not you're social, let's just say you got $1 million in municipal bonds, it's throwing off, I don't know, $30,000 a year. That 30,000 never goes on your tax return, but they know it. Well, they know it's there. It says amount received 30,000, amount taxable 0. But when they calculate whether or not your Social Security is taxable, that $30,000 would be included. And if it was a $10,000, you'd have $300 it would be included. So,
Okay. And so taxable income would be income if you're earning a salary, it would be your IRA
the
distribution.
IRA distributions, it'd be dividends, capital gains. If you have a part-time job, that would come in there, or a full-time job. Uh, interest, rent, things of that nature. So money that normally is taxed, excluding Social Security and municipal bonds, then you take half the Social Security benefit and all the municipal bond interest, and you just keep stacking them up. And if you go above those levels, then you pay the appropriate tax rate or appropriate amount of tax percentage is taxed.
Makes sense. Okay. On that slide, it also showed, it looked like married filing separately.
Yeah,
You,
they don't like
you
that.
tax again anything above
You're
zero.
gonna pay tax on everything if you do that.
Okay. What about someone who has their own business and maybe just, does not want to file jointly with their spouse? You recommend it anyway?
Well, you need to get your tax prepared to do that. But if you're living together, they treat you as a single person. If you're living apart, that's where it's just all fully taxable. So they're a little bit different there.
Gotcha. Okay. Is it true that some states do tax your Social Security? I know you said Georgia does not.
Uh, I'm sure that some of them do, but I do not know which ones. But I just know in Georgia, one of the nice things about the state of Georgia is the Social Security is not taxed, and your first $65,000 of retirement income, like dividends, interest, IRA withdrawals, is not taxed. So Georgia's very friendly for retirees.
Oh, perfect. Hypothetically, if a husband, the higher earner, passes away before his full retirement age, can the spouse still get survivor benefits or does that go away?
If the husband dies prior to
Prior to claiming?
starting benefits, right? Yes. So he's got a work record, and they take that record and they create a primary insurance amount at full retirement. The surviving spouse can apply for benefits as early as age 60.
Oh, okay. Okay.
Right. But it will be reduced about 30% if the surviving spouse waits until full retirement. Then if his primary insurance amount, she will get the higher of hers or his, whichever it is. Also, if you apply at age 60 prior to full retirement, remember I said if you're working and you make over $23,000 a year, for every $2 you make over 23,000, you have to give $1 back. So you need to take a look at that as well.
Okay. Those were all of our questions today. Thank you so much. And if you think of anything else you wanted to ask Chuck, email marketing@elevate-wealth.com. Then I'm going to share my screen really quick and show you all how to find us. You can find us on YouTube, and we're going to share this, and you'll be able to see all of our past webinars as well on our YouTube channel. Just look for Elevate Wealth Advisory in Athens. I'm also going to send a link to this out once it's recorded and uploaded. You'll be able to share that with any family or friends that might benefit from this. You can find us on the website at elevate-wealth.com. If you go to the menu bar, you'll be able to see where to register for upcoming webinars. You'll be able to find our blog. Lots of other great educational stuff is there. And then, of course, on Facebook, there's our team. There's Chuck. There's our CEO, Deanne. And here you can click on more and you'll see all of our upcoming events here, as well as just our regular social media posts. So I do encourage you to follow us on all those channels. And we'll look forward to seeing you next month when we're talking about managing your expenses in healthcare expenses in retirement. Thank you so much, Chuck, as always. We love having you on.
Thank y'all. Good seeing everybody.